In our last session, we focused on the Treasury function and how it manages liquidity on a day-to-day basis. We saw how Treasury is responsible for monitoring buffers, overseeing funding flows, and ensuring the bank is operationally equipped to meet its liquidity needs. Now it's time to zoom in on one of the most critical parts of Treasury's role: accessing funding markets. In this session, we'll explore the instruments and mechanisms banks use to raise funding, how they operate in secured and unsecured markets, how they manage maturities and pricing, and how they interact with counterparties and investors. We'll also look at the strategic considerations behind funding structure, diversification, and market presence. By the end of this session, you'll understand how banks move money in and out of the institution through capital markets and why effective access to funding is foundational to liquidity resilience. So let's begin with an overview of two primary categories of funding: secured and unsecured. Now, these terms refer to whether the borrowing is backed by collateral or not. In unsecured funding, the lender provides funds purely based on the creditworthiness of the borrowing bank. Now, common examples include deposits from corporates and financial institutions, interbank loans, and the issuance of debt instruments such as commercial paper, certificates of deposit, and senior unsecured bonds. Now, in secured funding, the borrowing is backed by specific assets pledged as collateral. Now, this includes repo transactions, covered bonds, and central bank operations. Now, unsecured funding plays a vital role in bank funding, especially in the short to medium term space. Corporate and financial institution deposits can be a major source of funding, often more volatile than retail deposits, but useful due to their scale and flexibility. Now, Treasury teams carefully monitor the composition, maturity, and behavioral stability of these deposits. Larger institutional clients, such as asset managers or corporates with operational accounts, may provide stable balances, but others, particularly if uninsured or yield sensitive, may move quickly if conditions deteriorate. Now, to diversify beyond deposits, banks also issue money market instruments like commercial paper and certificates of deposit. Now, these are short-term securities, typically issued with maturities ranging from a few days to a year, that offer investors a low-risk, liquid investment. Commercial paper is usually unsecured, while certificates of deposit may offer slightly different structures or terms depending on the jurisdiction. Now, these instruments are actively traded in secondary markets, providing the bank with flexibility and access to a broad investor base. For longer-term funding, banks issue senior unsecured bonds. Now, these can be fixed or floating rate, issued in various currencies, and structured to appeal to institutional investors such as pension funds, insurance companies, or asset managers. Senior bonds rank high in the capital structure, meaning they're paid before subordinated debt or equity in the event of default. Now, these instruments help meet the NSFR by providing longer-dated, stable liabilities. They also signal credit strength to the market, which can help reduce overall funding costs. In addition to senior bonds, banks may issue subordinated debt, such as Tier 2 capital instruments or additional Tier 1 AT1 bonds, which serve both capital and funding purposes. While more expensive due to their higher risk profile, these instruments allow banks to meet regulatory capital requirements while raising funding. Now, the choice to issue subordinated debt depends on the bank's capital structure, investor appetite, and pricing conditions. Now let's look at secured funding, which is equally important, particularly for managing short-term liquidity. Now, the most common form of secured funding is the repurchase agreement, or repo for short. In a repo transaction, the bank sells securities, typically high-quality liquid assets, to a counterparty, with an agreement to repurchase them at a later date, usually at a slightly higher price. Now, the difference in price represents the interest on the loan. Now, repos are widely used to raise short-term cash and are seen as lower risk by lenders thanks to the collateral involved. Now, the repo market is large, it's liquid, and highly technical. Pricing is driven by collateral type, term, counterparty risk, and broader market conditions. Now, during stress periods, repo haircuts may increase, meaning banks have to pledge more collateral for the same amount of funding, and counterparties may become more selective. Effective management of repo lines and eligible collateral is therefore essential. Many Treasury teams run collateral optimization models, which ensure that the best suited assets are used in each repo transaction, minimizing cost and preserving flexibility. In addition to repos, banks also issue covered bonds. Now, these are debt instruments secured by a pool of high-quality assets such as residential mortgages or public sector loans. The key difference between covered bonds and securitizations is that the assets remain on the bank's balance sheet and investors have dual recourse, so both to the underlying asset pool and to the bank itself. Now, covered bonds are popular in Europe and are seen as highly secure by investors, often attracting favourable regulatory treatment. They offer longer-term funding and are an important part of many banks' funding strategies. Securitization is another form of secured funding. Now, in this model, banks pool assets such as mortgages or auto loans and transfer them to a special purpose vehicle which issue asset-backed securities to investors. The bank receives upfront cash in exchange for the future cash flows of the assets. Now, securitization can be a powerful funding tool, allowing banks to transfer risk and access new investor pools. However, it comes with greater complexity, regulatory scrutiny, and operational requirements. Central banks also provide secured funding, typically through standing facilities or open market operations. For example, the Bank of England offer indexed long-term repo operations and other liquidity schemes. Banks can pledge eligible collateral, often government securities or top-rated assets, in exchange for cash. Now, these facilities are not just for crisis moments, they're also used to manage seasonal flows, collateral availability, and short-term mismatches. Now, having access to these facilities with pre-positioned collateral and tested procedures is a key part of liquidity resilience. Now, the choice between secured and unsecured funding is strategic. Secured funding is generally cheaper and more stable, particularly in times of market stress, but it comes at the cost of collateral, which must be managed carefully. Unsecured funding is more flexible and scalable, but often more expensive and more sensitive to credit perception. Most banks aim for a balanced mix, diversifying across sources, tenors, instruments, and investor types. Now, this leads us to the concept of funding diversification. One of the most important principles in liquidity risk management is not to rely too heavily on any single source or channel of funding. A bank with a concentrated funding base, such as a heavy reliance on short-term wholesale deposits or one dominant investor group, is inherently more vulnerable. Treasury teams track concentration metrics, set internal limits, and report exposures to ALCO and regulators. Diversification covers currency, maturity, counterparty, and instrument type. Now, currency is particularly important. A bank operating in multiple markets must fund itself in multiple currencies. Now, foreign exchange swaps, cross-currency repos, and multi-currency bond issuance are tools used to manage this. Now, currency mismatches introduce additional risks, including basis risk and convertibility concerns, which must be managed within the bank's liquidity and market risk frameworks. Regulatory regimes increasingly expect currency-specific liquidity metrics, not just consolidated views. Now, maturity diversification is equally crucial. Banks avoid having funding cliffs where large volumes of debt mature at once. Treasury teams stagger maturities across different time buckets and geographies, creating a smooth funding profile. Tools like funding maturity ladders help visualize and manage these exposures. Now, from a strategic perspective, market access is everything. A bank's ability to raise funding at reasonable cost depends on its credit rating, investor relationships, regulatory standing, and reputation. Now, Treasury teams engage actively with investors through roadshows, issuance updates, and feedback sessions. Investor relations and Treasury must work hand in hand to maintain transparency, deliver credible funding plans, and respond quickly to changes in sentiment. Now, regulatory requirements also influence market activity. The NSFR creates incentives to issue longer-term funding. The LCR encourages the use of certain instruments over others. Capital planning, recovery and resolution frameworks, and systemic risk buffers all feed into funding decisions. Treasury teams must balance these constraints with pricing, market dynamics, and internal business needs. Now, post-crisis reforms have also introduced new tools for planning and supervision. In the UK, the PRA 110 reporting template captures granular funding data, helping supervisors understand banks' reliance on different sources. In the EU, similar templates exist under the European Banking Authority's guidelines. Now, these reports help detect vulnerabilities early and feed into supervisory dialogues. It's also important to consider market readiness during times of stress. In a crisis, unsecured markets may freeze, repo haircuts may spike, and central bank facilities may become the only available option. Banks must therefore maintain access to these channels, build redundancy into funding plans, and test operational readiness. Treasury stress tests include assumptions about market shutdowns, repo gridlocks, and counterparty withdrawals. Now, one interesting development in funding strategy is the rise of green and sustainable funding instruments. Many banks now issue green bonds, social bonds, or sustainability-linked instruments. These products attract ESG-focused investors and support broader strategic objectives. Treasury teams must work closely with sustainability functions to structure these instruments appropriately, align with frameworks such as the ICMA Green Bond Principles, and provide transparent reporting on use of proceeds. So to summarize, accessing funding markets is at the heart of liquidity risk management. Banks must navigate a complex landscape of instruments, counterparties, regulations, and market dynamics. The key is to maintain flexibility, diversification, and credibility. Treasury teams are the stewards of this process, executing funding strategies that support resilience, regulatory compliance, and business growth. In our next session, we'll explore how liquidity risk management plays out across international operations. We'll look at how banks manage liquidity in a cross-border context, how they deal with ring fencing, fragmentation, and jurisdictional challenges, and how they maintain resilience across legal entities and currencies. I'll see you in the next session.